Now we're going to consider long-term liabilities, and as I indicated to you, we're going to look at bonds. There are other types of long-term liabilities. So we said that current liabilities are obligations that must be satisfied within 1 year or less. With long-term liabilities, we have more than 1 year to make a repayment. Bonds are a form of interest-bearing notes payable, and we had talked about notes payable when we talked about current liabilities. Bonds can be issued by government. What we're going to be focusing on are corporate bonds. Usually, a bond has a face amount of $1,000. Corporations issue bonds so that they can borrow money, and what they're doing is they're borrowing money for long-term projects. So they're looking at long-term funding for a long-term project, which might include going into a new market, doing some building, acquiring another business. The individuals or institutions that buy the corporate bonds are called bond holders. Typically, the bonds are bought by other corporations or institutional investors. This slide in a illustration breaks down some basic types of bonds, and you can read about this more in the textbook. Secured bonds, it means that there's collateral or something to back those bonds up. So an example would be buildings. Unsecured bonds, there's nothing backing them up. So an example would be a debenture bond. That's the highest quality bond. So companies with the highest credit ratings can issue debenture bonds because they are considered so solid in terms of repayment. We have convertible bonds. Those bonds may be converted to stock if the bondholder would like to do that. The stipulation or the specifics for that conversion would be disclosed in the bond indenture, which is the legal agreement that lays out key information for a bond issue. The last type is callable bond, and most bonds are callable. And when we mention callable bonds, what we're talking about bonds that have a call provision where the issuer, so the issuing corporation, may buy back their bonds at a predetermined call price, which would be in the bond indenture, and that the investors would have to sell them back to the issuing corporation. The biggest reason that a corporation would want to buy back its bonds would be in the event that interest rates have decreased and that the contractual interest rate on the bonds that they have outstanding is higher than the prevailing rate, so that they want to reduce their interest expense. They call back those bonds and reissue a new issue of bonds to replace the ones that they've bought back. So, state laws will grant corporations the ability to issue bonds. Board of directors and stockholders must approve the bond issues because, of course, we want to make sure that the corporation will be able to make the repayments. And for the stockholders, the more debt that a company incurs, the more risk the shareholders incur, because if the corporations default on their bond repayments and their interest payments, it's the shareholders that are going to lose out. They'll lose their dividend payments in the event that the company is liquidated, they lose their investment in the corporation. Also, there's interest expense that accompanies those bonds, which will decrease profit, and shareholders want to see higher profit, which could impact the profitability and the stock price of the company. The board of directors must determine the number of bonds to be authorized, so that's the maximum number of bonds that can be sold, the total face value, so the total amount of funds that they want to raise from a bond issue, and the contractual interest rate, so it's the rate at which the interest must be paid to the bondholders or investors. That rate does not change throughout the term of the bond. So if it's a 30-year issue, that contractual interest rate will not change as long as that bond issue is outstanding. So the changes in market interest rates will be totally irrelevant. I've already mentioned the bond indenture. That's the legal document which lays out the bond terms. And a bond normally has a face value of $1,000. The bond represents a promise to pay, so it's a form of a promissory note. It's a promise to pay a sum of money at a designated maturity date, and what will be paid is the face amount or the par value of the issue. So example, we said that the face value of a corporate bond is $1,000. So at maturity, $1,000 per bond must be repaid. Or if the face amount of an issue was $500 million, at maturity, $500 million must be paid. Now, there is a possibility that the bond was issued for less than the face amount or more than the face amount. Regardless, the face amount is repaid. And of course, the issuing corporation is promising to pay interest on the contractual interest rate, and that interest is calculated on the face amount of the bond. The interest payments are usually made semi-annually, so the interest payments will be the same in each interest payment period. By issuing bonds, the corporations can raise large amounts of long-term capitals. And typically what will happen is an investment banker will underwrite the bond issuance and will sell the bonds for the issuing corporation. All right, in this slide, they give three factors that impact the current market price of the bond. And they put present value. We are not going to go through this calculation. It's very involved, and that's something for a more advanced course. The only thing that I want to call your attention to is the last line on the slide. It says, the market interest rate is the rate investors demand for loaning funds. Another way of looking at that is it's the prevailing rate of return on other investment alternatives. And what we're going to look at is the relationship between the contractual interest rate and prevailing market rates and how that impacts the price of the bonds. But we're just going to look at it very basically in conceptual terms. Right. Corporation records bond transactions when they issue or sell bonds, when they buy back bonds, or when bondholders convert bonds into common stock. Now, there is a note here. It says, if the bondholders sell their bond investments to other investors, the issuing company receives no further money on the transaction, nor does the issuing company journalize the transaction. All right, so what would be happening here is that the bonds would be sold on the secondary market. So the transaction would occur between the initial owner of the bonds and the buyer, so that the corporation is not involved. And we're going to see this with stocks as well, because stocks are also sold on the secondary market, but we'll talk about that when we get to this stockholders equity chapter. Alright, so in this illustration we have three scenarios. First of all, we have the bond with a contractual interest rate of 10%. And here are the three scenarios, and unfortunately the third column where it says bonds sell at, those three boxes are blank. I think I downloaded the incorrect slide, but I'll give you the information, and it's also in the text. This illustration is in the text. Alright, so we're looking at a bond issue. The contractual interest rate is 10%. In the first scenario, the other investment alternatives are paying 8%. So therefore, the bond issue would be far more attractive because the rate of return is higher. So that in this case, the bond will sell at a premium or above face value. All right. So once again, when the contractual interest rate on the bond is greater than the market interest rate, then the bond is more attractive and will sell at a premium. In the next scenario, the market interest rate is 10%, which is the rate of return for the bond issue. In this situation, investors would be indifferent between this bond issue and other investment alternatives. And of course, we're simplifying the matter here. We're just looking at rate of return, not other factors. In this case, the bond price would be equal to the face value. So again, if we assume that the face value per bond is $1,000, then the price per bond would be $1,000. The last scenario, the market rate of return is 12%. So now, in looking at that bond issue, it's not as attractive because there are other alternatives that would yield a higher rate of return. So now the bonds become less desirable, which puts downward pressure on the price of the bonds, so they will sell at a discount or below the face value. So for our purposes, one of the things that is very important for you to understand and remember is the relationship between market interest rates and how they impact bond prices. So in terms of raising long-term funds, corporations have two alternatives: debt and equity. In the next chapter, we are going to look at the equity piece. But let's just look at very basics in terms of which may be better or not. All right, with bond financing, stockholder control is not affected. And the bondholders do not have any voting rights, so that the current stockholders still maintain the full control of the company. Bond interest is a tax-deductible expense, whereas dividends are not tax-deductible. So, debt is a cheaper source of financing. The problem, though, is that in the event that a corporation runs into some cash flow problems, they are obligated to pay that bond interest, whereas dividends they do not have to. So the bonds may be cheaper, but as you add more debt to your capital structure, you are adding more financial risk, and the risk that you're adding is a risk that the corporation may not be able to meet its obligations, i.e., the interest payments, and ultimately the repayment of the face amount of the bonds. All right, number 3. We're not going to discuss return on stockholders' equity, that ratio, in this class. But it is an important ratio from an analytical point of view. We already said that bond interest expense will reduce net income. But the return on stockholders' equity is usually higher. It usually goes up rather than down because the bond financing does not add any more to the common stockholders' equity. So that the decrease in the decrease in net income will not adversely affect the ROE. But that's something that we're really not going to talk too much about, so you don't have to worry about that. That concludes what we're going to cover in terms of liabilities. We are not doing any problems with respect to liabilities. I want you to understand what these liabilities are, and I want you to understand the difference between the long-term liabilities and the current. And I also want you to understand the difference between debt and equity as sources of long-term financing. And of course, in the next chapter, chapter 11, we will look at stockholders' equity.